Exxon beats earnings estimates despite lower oil prices. Exxon Mobil's latest earnings reveal a story that many in the industry didn't expect, and it's sure to fuel plenty of debate. Yes, profits are down compared to last year, but the company still managed to outpace expectations, delivering some numbers that show the oil giant isn't running out of steam just yet. Want to know how they pulled it off? Keep reading, because there's a twist most headlines miss. For the second quarter, Exxon Mobil posted net earnings of $7.1 billion, translating to $1.64 per share. That's a noticeable drop from 2024's $9.2 billion, or $2.14 per share over the same period. What's behind this sharp decline? The answer lies partly in global oil prices, which have slipped by roughly 10%. A shift driven by OPEC Plus ramping up output and a strong supply from U.S. producers. So while it might seem like a tough quarter, Exxon actually surpassed Wall Street's predictions. Analysts polled by LSEG had expected earnings per share to dip to just $1.54, and the company easily cleared that bar. Revenue also beat forecasts, registering at $81.5 billion versus the expected $80.77 billion. Here's where things get particularly interesting. Exxon's oil and gas production soared to 4.6 million barrels per day during the quarter, the highest second quarter figure since the company's famed merger more than 25 years ago. Growth in the Permian Basin was a key driver, hitting a remarkable record of 1.6 million barrels per day. Increased output in Guyana also played a crucial role. These production gains cushioned Exxon's results, helping to dampen the sting of weaker oil prices. But let's take a closer look at the breakdown of profits, a point that's bound to spark some controversy. The upstream production business, despite impressive volumes, saw profits shrink 23% year over year, down to $5.4 billion. Blame sagging oil prices for that. Meanwhile, Exxon's global refining business benefited from improved margins, pulling in $1.37 billion, an eye-catching 44% boost compared to $946 million last year. This contrast highlights how volatility in energy markets can shift fortunes between different arms of the company. Another angle sure to catch critics' attention is how Exxon is rewarding its investors. During the quarter, the company dished out a staggering $9.2 billion to shareholders, splitting it between more than $4 billion in dividends and $5 billion in stock buybacks. Looking forward, Exxon expects to repurchase a whopping $20 billion worth of its own shares this year. Does this aggressive buyback program benefit long-term growth? Or does it favor shareholders at the expense of sustainable investment? That's a point many will debate. Operational efficiency has also been front and center. Since 2019, Exxon has cut $13.5 billion in costs, including $1.4 billion so far this year, with plans to trim an additional $4.5 billion by the end of 2030. These efforts are designed to weather periods of market turbulence. But some question how far cost-cutting can go before it begins to impact innovation or workforce morale. And here's a final thought to chew on. While quarter-to-quarter fluctuations capture headlines, the real controversy may be about Exxon's broader strategy in a world shifting toward cleaner energy. With record production and bold shareholder rewards, is Exxon preparing for long-term challenges or just maximizing value in the short run? What do you think? Should Exxon prioritize production and shareholder returns, or pivot more aggressively towards sustainability and renewable investments? Are these results a sign of resilience or a warning signal to traditional oil giants? Share your opinions below and join the discussion. Let's hear where you stand.